Good evening, partners, and welcome to the session. So today's session, of course, is on the new equity mutual fund selection process. So myself, Pratik Jain, and I head the products for the Digital Well team. And today we have Shweta Rajani, who's the associate director, and it's basically Shweta and her team who actually does the work on the mutual fund selection process. So uh, we have Shweta who would actually take us through the new selection process, the changes which have happened, and what's the rationale behind it. And if there are any questions or queries, we can take them, post that. And I'll also brief on how are we going to execute the changes in the selection in the new model portfolio. What are the actionables at our end? So these are the two broad topics which we would discuss. So over to you, Shweta. We'll start with the selection process. I'll share the screen. Just give me one second.
Sure.
Yeah, you can see the screen, Shweta.
Not yet. Yes. Great. I can see it now. Good evening, everyone. So like Pratik was mentioning, and I'm sure a lot of you would be aware of our process, because every year we go through 2-3 months of rigorous exercise, going through each and every step of the selection process to see what changes we want to make in the process itself, as well as as an outcome in the model portfolio. So I'll just take you all through highlighting the process, and also in between highlight what changes we've made. Yeah, can you? Great.
Just give me one minute, Shweta. I think so. I'll just share the screen as such, so it would be easier because. Just give me 1 minute. Share the window specifically. Yeah.
Super. So, like you would have heard me even previously saying that when we are constructing the model portfolio, the whole idea for us is that we're trying to target a 3% alpha over Nifty 50. Now, for a lot of clients, it may say 3% is a small number, but actually, if you see the compounding effect of that 3% per annum, it turns out as, after a 10-year period, it's as good as your principal value coming back. So the objective is 3% to Nifty 50, which is the benchmark that we are using. Also, just, in terms of expectation setting with clients, and a lot of the times you may be facing these questions coming in from clients saying that mutual fund is such a standardized process, we can do our own selection, why do I need to come to you? So we wanted to highlight to clients that this is not something that can be done at an individual level. What happens is, if you see the overall universe of funds, you have approximately 700 open-ended equity funds that are available today. And even if your client wants to have, let's say 14, 15, 20 schemes in his portfolio, then you're basically looking at arriving at a universe which is less than 5% of the total universe. Now, what is the probability of you going right if you are independently, individually analyzing data? And the cost of going wrong is also huge, because you'll see that, for the last 11 years, for every year, we've seen what the best scheme return was, what the worst scheme return was. And if you do it as an average for the last 11 years, it's been at 52% per annum. So that's significant. There is a huge variation in best and worst. So which is where we are saying that you need to have a right selection process in place. And that right selection process means a lot of data crunching, accessibility to data, which cannot be done at individual level. You need to come to an institution which, one has access to the information, second has the manpower to crunch all that data, analyze it, get the insights from it and apply it into a model portfolio. Also, what happens is, when we say a 3% alpha, what I also wanted to share with you all was that historically, what has been achieved is actually a 4.2% per annum alpha from 2013, from the time we've been following this, which means for anyone who started with 10 crores, approximately 18 crores has come in only because of this alpha. But alpha generation is not linear. We don't expect 3% to come every year. Like you'll see over year, there are 50% years where the alpha would have been less than 3%. So therefore, from an expectation standpoint, a client should not expect 3% every year. Also, a client should not be anxious if you see years which are less than 3%, because as time passes by, mean reversion takes place, you'll get to your 3% alpha. Also, a 16% 1 year doesn't mean every year, you'll see double digit alphas. If 1 year has been good, the next year you can expect, somewhere for it to get normalized. Thirdly, 3% is from a basket of funds. It is not from individual schemes. If you look at the industry-wide data, right, for the last few years that we've been tracking, on an average, 35% of the funds in the industry underperform Nifty 50. And by that logic, if we have 14 schemes, 5 of them could be underperformers. But because there's a well thought out selection process, we think we can bring it down from 4-5 to 2-3, but you'll still have those 2-3 underperformers. And that's why we tell all clients, do not pick and choose, because you don't know what's going to not perform, in the next 1 year. Invest in the basket to its entirety. From the whole, a 3% expectation after considering for 2-3 schemes going wrong is, what has been priced in. Right? But that's just on the expectation bit. How do you actually arrive at that universe? And here what we do is, according to us, there are 3 sources that contribute to this alpha. First one is the market cap allocation, which is nothing but how much of large cap, mid cap, small cap we should have in our portfolio in a given year. Second is which categories of funds should we invest into. So, how much in the large cap fund, how much in the flexi cap fund, how much in the multi cap fund. That's the second contributor. There will be certain categories which have low alphas that they've generated in past, certain categories which cannot deliver alpha. So you need to, avoid them. Third is the scheme selection, which is an outcome of both quantitative as well as qualitative assessment. But A versus B scheme also adds to this outperformance number. So, starting with each of these. So when I'm saying my source 1 is market cap decision, how have we arrived at that decision for this year? But before I get how have we arrived, what is my universe? Now you'll see here that what I'm saying is large cap is the top 100 companies as per full market cap. That is what is the SEBI definition. According to SEBI, top 100 companies are large. Next 150 is mid. Everything below that is small, which internally we've broken up into top 250 small cap and everything below that as small cap. You see the numbers there as well. So in market cap terms, anything above 67,000 crores is large. 22,000 to 67,000 is mid. Below 22,000 is ideally small, but the 500th company is at 7,000 crore market cap. 500 first onwards is below 7,000 crores. Right? Now what happens is mutual funds, according to the SEBI rules, have to invest according to this market cap definition. So when SEBI tells a large cap fund that 80% of your investments have to be in large cap stocks, they are referring to these 100 companies. But when the mutual fund is benchmarking, they're benchmarking it to Nifty 100. Right? So the point I'm trying to highlight is that you will see similar Nifty indices too as Nifty 100, Nifty Mid Cap 150, Nifty Small Cap 250. But that universe is different than the SEBI defined universe. Because SEBI has different rules. SEBI is saying only go with full float market cap. NSE has different rules basis which they construct the index. Outcome is in the large cap space, 8 companies differ. In the mid cap space, 19 companies are different between SEBI and Nifty universe. in small cap 250, you have roughly 45, 46 companies which are different between the SEBI universe and the NSE universe. Now, which of this is relevant for us? It is clearly the SEBI universe which is relevant for us because mutual funds are going to invest there. And what we want to evaluate is the future earnings, the valuations, the opportunities that are available for the mutual funds in which we will ultimately invest. Therefore, what you'll see in the following slides is we were forced to create 3 indices and we've called them as AR large 100, AR mid 150, but this is nothing but the SEBI universe. Now, there are 4 variables we've actually checked before we could arrive at our market cap decision. The first one is, like I said, the future earnings potential. So what we do over here is for these 100 companies in the large cap space, we go ahead and see what is the analyst estimates on the next 1 year's profit growth of those companies and arrive at the universe's weighted average growth estimate. So for large cap, it's at 8.5. Mid and small is significantly higher at 30 and 21%. So what this is telling me is if I only look at the earnings projections, then there's a very high chance that if these companies are going to grow at 2x, 3x higher earnings than large cap, having a higher weightage there would mean a higher alpha possibility to Nifty 50. So being in the mid and the small cap space with a significant allocation may be a good thing. But next, we've also checked the valuation. At what price are you entering? If you're entering by paying a very high price, then that earnings may not translate into price growth. So when you look at the forward PE multiple here, we saw that large caps were trading at a 21 PE, mid at 27, small at 23. But then we noticed that there were certain outliers in the mid cap space. There were around 4-5 companies which were trading at 100 plus PE multiple. If you eliminate them, then broadly you see, large and small did not have so many outliers. So 21 is the price you pay for large. Mid and small is not very far off. You're just paying a 2 or a 3 PE multiple higher, but the earnings differential between large, mid, and small is significantly high. So by paying a little higher price, the earnings could be much, much higher. And therefore, it's telling me that, broadly, it's not a very expensive zone, a high probability that a lot of this earnings could translate into price growth. Next, what we checked was the market risk, because perception is mid and small is more risky than large. But technically, that's not the case. So when you check beta of mid cap or small cap with that of Nifty 50, you'll see it's lower. Moreover, mid and small have similar beta ranges. So it's not that small cap is riskier than mid cap. And as your time passes by, you'll see the beta element falls a little. The final check we wanted to do was, while we checked the market risk, we also wanted to check liquidity risk, and we wanted to check where the money is getting invested today, because flows in the short term also provide some kind of stability. Demand supply impacts in the short term. So that's where what we've done is we looked at the SIP flows, because that's sticky money. So while there would be other sources, the lump sum money going in, the other domestic institutions, FII buying, all of that. But this is also directionally giving us some sense, because this is sticky money that comes in every month. Because this is an average of the last 6 months, and this only takes into account the money getting into equity schemes as SIP, you see the average number over there at 14,000 and not the 20,900, which would be the latest SIP number. Now here what we observed was approximately 40% of the money goes into the large cap space and 30% each is getting into mid and small. So there's, decent amount of money that's getting into all 3 segments. And the last check we've done is on the liquidity risk. Now liquidity risk is twofold. One, if more money comes into this segment, will they be able to scale it up? Will they have enough opportunities to invest? Second, if there is redemption pressure, will they find enough buyers for the stock that they have? So will they be able to, exit from their positions? So which is where I'm just going to take small cap 250 companies as an example here. What we've done is we've looked at the total market cap of this universe. That stood at 31.13 lakh crore for the 250 companies. But this is including the promoter holding as well, which generally does not get traded. So if you exclude the promoter holding, then there is 12.67 lakh crore of stock available in the market. Next, we looked at all the equity funds, which are 696 equity schemes, and we've seen how much of their investment has gone into these 250 companies. And that is 3 lakh crore, which has gone into this segment. So roughly 25% is their ownership. Now, what this tells me is if, let's say tomorrow, 50,000 crore more comes into small caps via multi-cap fund, small cap fund, flexi cap fund, they have enough opportunity because there's 9 lakh crore worth of opportunity of investment. Second, if there is a redemption pressure, if they need to, sell, let's say 50,000 crores, here again, 75% is owned by others. They'll find enough buyers in the market. And that tells us again, even from a liquidity standpoint, there's not so much to worry about. After looking at all these four variables and giving a certain score to each of them, we felt that we could continue broadly with our last year's allocation of being heavy towards mid and small. So we've done some minor tweaking here. Instead of 50, we are saying 55 large. The rest 45, instead of being heavy towards small, we are equally splitting between mid and small. So while, the final outcome was very similar to what we were maintaining till last year, but we relooked at each and every data point to, see directionally what the numbers are indicating. And then as a final check for this stage, what we've done is we've seen what the weighted average earnings growth is coming to, and that showed as a potential of 17% against a Nifty 50 of 11%. So this is telling me, the earnings potential is 6% higher than that of Nifty. If earnings potential is going to be high, a very high chance that it translates into price growth. So, high probability of you getting to that 3% alpha. Again, at risk levels, which could be lower than that of Nifty 50. So this is how, we arrive at the first decision of how much market cap allocation we want to have in order to increase the probability of a 3% outperformance. We then go to the next part, which is deciding on categories and seeing which category, how many schemes do we want to allocate. Now, here we look at the data for the last 6 years, and what we basically check is how many funds in each category would have outperformed Nifty 50 and their own benchmark, and by average, what alpha. So, while a large cap fund, according to the SEBI definition, has to invest 80% of their money in the top 100 companies, you'll see other categories also which are large cap heavy. Like flexi cap, we've seen in this category, almost 70 to 75% is invested in, again, the top 100 stocks. Dividend yield is another category which tends to be heavy towards large. So if we want a derived 55% large cap exposure, I don't necessarily need to have 3 large cap funds, which historically is given only 3% alpha. I can also derive it through flexi cap, which is given a 6% alpha. I can also derive it through dividend yield, which is given a 6.5% alpha. So that's how, you will see we've selected funds where there was a higher potential of, historically at least data that they've delivered a high alpha. More number of funds in that category have outperformed. We've gone ahead and, given allocations to those categories. And roughly what we then did was we again checked that if historically I had, allocated in this way, then according to the category's average alpha, what could have been, our outcome? And that you'll see turned out at around 7.27%. So then if 7.2% has come, we'll of course apply a scheme selection also within this, but this tells me that 3% is again a possibility. So at every stage, you'll see we go back and see what's the chance of the objective being met. The objective being 3% outperformance, and try to have risk levels which could be lower than that of Nifty 50. What happens is we do eliminate certain categories like, an index fund or, some other sectoral funds. And then you come down to 309 schemes. On this, we apply AUM filters. So at AMC level, you'll see that there's a 3,000 crores of minimum requirement. At scheme level, there's 1,000 crore of minimum requirement. And whoever has seen this presentation, even last year, will see that at this stage, we've not made any change to these filtration criteria or to the way we've been picking up our categories. So we felt that there was no need at this point of time to tweak these AUM filters. So we've continued with them. And you then come down to a universe which is somewhere around 177 schemes. On this 177 schemes, we want to pick, the top 25% of this universe. So which is where we apply our quantitative ranking. Here again, you will notice that there are 5 variables, but of the 5 variables, 4 are same as the previous year. There's one new variable that we've added. But we've gone through, the entire exercise of seeing if they're still valid or not valid. Like when we were applying the statistical parameters, and there are 100 odd statistical parameters which are there. We went back, we redid the correlation exercise from 2005. So today we have an 18-year data where we've seen what is the correlation of that one variable with the next 1 year's return. The whole idea is to have a forward-looking process and not just relying on historical return. So even if you're looking at certain statistical parameters which actually look at your historical NAV, you are seeing where you could bring in more predictability. And that's where regression analysis and applying this correlation actually helps us. So 9 parameters where the correlation has been very strong with the next 1 year's return, either on the positive side or negative side, gets selected. This is not different from what you would have seen the last year. So the parameters, even when this year we've done the correlation exercise, gave us the similar outcome. So we've continued with those 9 variables and ranked the funds on these. And then how do you actually check? You see, ABC fund, 5 out of 9 variables, it came in the top quartile, or 0 out of 9, it came on top quartile. And that's how you rank it. The second variable that we apply is the future return potential. So just like, when we were doing for the index, we've computed what the earnings expectation is for the next 1 year. Here again, we've relooked at, what has been the, what possibly can be the earnings for the next 1 year. The third variable is the active weight. Now, what we are trying to strive is to have a scheme which can give me that outperformance to Nifty, which can only happen if the fund manager is taking certain active calls. It's like this, if Reliance Industries is 10% in the benchmark and you also go and buy 10% Reliance Industries, there's no active weight. Your fund is going to replicate the benchmark, to the extent of that 10%. But if you choose to have only 3% of Reliance Industries and 7% you go and buy something else. So 7% is that active weight. The higher the active weight, at least more opportunity for outperformance. So that's another thing we check. Fourth one is called as excess return due to active management. Very simply, what we are trying to do is we are trying to see that fund manager who's taking those active calls, whether he's creating value by those active calls or no. So, rather than going with perception about how you think about a fund manager being good or bad, you're actually trying to see mathematically that he coming to work every day, is he creating value or no? So what we do is we look at a year back portfolios and run those static portfolios to see if there was no change made by the fund manager during an entire year, what would have been the return of the portfolio? Let's say it turned out to be 20% for a certain scheme, but the fund managers would have made some changes to their portfolio, some sectoral changes, some stock changes, and if that portfolio delivered 30% return, so there's a 10% which has come in because of that active calls. So like that, we see which fund managers have created positive value, and positive value not just in 1 year but 3 independent years. And that's how you shortlist funds which would have done that consistently. The last variable is a new addition to the selection process. We thought we should have one more check, and here what you're trying to do, as the name says, it's last year's return versus commonality of the portfolio. This is helping us understand if there is a possibility of mean reversion in a fund's performance. What I mean by that is, the principle of mean reversion says that if some particular fund or stock has done well 1 year, low probability that it will continue to do well next year too. So let me take an example. Kotak Multi-Cap Fund, right? This fund has had delivered around 50% return in the previous year. It was among the top performing funds in the category. So it's had a good past 1 year return. Now this good return came in clearly because the underlying stocks did well. So, the stocks in his portfolio approximately would have also risen by 50-60% for the fund to deliver 50%. Let's say, for example, the fund had 30 stocks. So those 30 stocks have ran up. Now you go back and check how many of these 30 stocks he's changed. Let's say he continues to hold the same 30 stocks. So portfolio commonality is 100%. There is a high chance that this year the fund may not do well because a stock which has gone up by 60% the previous year, you are expecting it to rise further, which is a low probability event. But let's say out of those 30 stocks, he changes 20 stocks. Now he's relying on new set of 20 stocks to do well. And ideally, a fund manager would follow the philosophy of buy low, sell high. So what he's bought would, you're expecting would have an upside potential. So the chance of this fund's good performance continuing even this year increases because there is an underlying change in the portfolio. The opposite could also happen. A fund which has not done well the previous year, if he's continuing to hold the same stocks, there's a high chance that those stocks, because they've not ran up the previous year, they'll run up this year. So the fund could see a turnaround. So this is one check that we added, as an additional checkpoint in the ranking process. And like I said, we rank the funds on these 5 variables to see which fund would have come on top on 5 out of 5 variables or 4 out of 5 variables. And then you come at a shortlisted universe of 36 funds. On this 36 is where we apply a qualitative judgment or, a subjective assessment, which for us is done at 2 levels. First level is where the fund team, the mutual fund team, meets the fund management team and tries to get insights from the fund manager. So you try to assess the fund manager's confidence on the scheme. What's the overall research strength? Is there a likelihood of any change in the fund management team? So on and so forth. And as a second level check, Feroz Aziz, who's a deputy CEO, he independently interacts with the CIOs of these fund houses to again get a sense of, a view. So he has, we'll have a due diligence questionnaire for him too. And then all of this is discussed out internally. The investment committee has been involved in this. You arrive at a shortlist of first 23 schemes from 36, and then from 23 to the final 14 schemes. That's how it goes. The entire investment committee, you'll see that it constitutes of the CEO, deputy CEO, the economist, sales, or the front end, the director of research, all of them are involved in this entire process. And then you finally arrive at the model portfolio. So right now you'll see that there are 14 schemes. So there are some changes. We're going to highlight on those changes. So there's Franklin Large Cap moved out, Quant Large Cap come in, Canara Flexi moved out, Canara Multi come in, Aditya Birla Small Cap moved out, SBI Infra come in. Some weightage changes here or there because you wanted to align it to, the market cap mix. But what we do again at this stage, after we've selected the funds, we go back and see that for this combination, what could be the earnings potential? And here you'll see that turns out to be at around 21%, as against the Nifty's earnings potential of 11%. So this is showing a 10% higher return potential, which this is the earnings differential. If a lot of this can get translated into the price differential, and therefore, it looks a high probability of this year also achieving the 3% alpha with this basket. At risk levels, which are very similar to what we've been maintaining at 0.85, 0.86 beta to Nifty 50. So that's how, the portfolio gets constructed. If we can just go one slide back, I wanted to highlight one thing. Yeah. So you will see that the SBI Infra Fund is getting categorized as multi-cap. Now, a lot of people say this is a sector fund. And yes, according to the SEBI definition, this is a sector fund. But then when you're eliminating categories, for sectors, what we do is we see what is their underlying sector exposure. So are you exposed to one sector, two sector, three sector, five sector, seven sectors? If you have less than three sectors as your underlying portfolio, then we call it as a sector fund. But if you have more than 7 sectors in the portfolio, then your name may sound like a sector fund, but you're really not a sector fund. So in case of infra, they had approximately, 8 out of 11 Nifty sectors. Then we said this is not really a sector fund. This is a quasi-diversified fund. So you should consider some of these, and that's how 4-5 of those infra funds came in that shortlist process of 177 schemes after the AUM filter. The reason it went into the multi-cap category was because we looked at the underlying market cap split, and that was somewhere, very multi-cap in nature. So it got ranked along with the multi-cap funds. We are not taking a sector call. We've not been taking a sector call. This fund, because it was multi in nature, optically, the name sounds as infra. The portfolio, if, I'm sure all of you all would have access to the portfolios. If you see its top holding is Reliance Industries, there's 17% banking. You'll see durables in the portfolio. So it's not a pure infra fund. For us, it's as good as any other diversified fund playing certain themes in the portfolio. So that's, one take, because this is something which very commonly comes to me. I thought I should also highlight it, but I think I will stop my monologue here. Happy to take up any questions that you all may have.
Thanks, Shweta. I think so. One common question would be there, Shweta, on the quant inquiry, which is ongoing. So there were questions from the partners also that is there any actionable at our end, because we have now 2 schemes of quant in our portfolio. So if you can actually give a brief there as well, Shweta.
So I think, see, on quant right now, a lot of it that a lot of us are listening is what is getting published in media, or the calls that have happened from quant, or the FAQ that's been released from quant, right? At this point of time, there's no communication from SEBI highlighting what exactly is the inquiry they've done, correct? But the way we look at it today, what is the risk? There is a negative news on the AMC. There's no negative news on the underlying stocks, right? So one should not react on news, especially if it's on the fund house, because the underlying portfolio would not correct because of that. It's not like, ABC stock, there is a negative news and therefore you'll see a 50% correction in the stock price. It does not affect the portfolio quality. Now, the only risk is if there is a redemption pressure, then the fund manager would be forced to exit from certain stocks, which has also not happened. And at least I can tell you for the two funds that we have, we've been tracking their outflows very closely. For large cap, on Monday, there was like a 15 crore outflow. On Tuesday, there was 11 crore outflow. On Wednesday, there was a 1 crore positive inflow. That's the situation. Even if you look at the return of the large cap fund for the last 3 days, it's 0.27% up. And it's 100% large cap portfolio. There's, anybody can look at the portfolio quality. There's no issue. Likewise, if you see with Quant, it's 11,000 crore fund. What has gone out in the last 3 days is somewhere closer to 270 odd crores. Actually, a little less than that, maybe. But yeah, there again, we've seen, first day 96 crores, then 95 crores. Then I think yesterday the flows have been much lower in that too. Some 27 odd crores have been the outflow. So there isn't too much of liquidity stress. The portfolio performance there is a negative 0.85 in the first in the last 3 days. But portfolio quality, even for a active fund, is 45% large. So there's no redemption stress that we are seeing. There's no portfolio quality issue. Now the chance is that what if the fund managers involved and dealers are involved, and could it be something like Axis? Unlikely to our mind, because here if you see, the CIO is also the owner and he has a lot more at stake, than what we are listening in media as could he be involved in the suspected or the alleged front running case. If that is really the case, we don't even know what the inquiry exactly is. So if there is an employee involved, you really can't hold the organization for it. Unlikely it could be a case where we've seen, with Axis, where you had a lot more people involved in it. So that's our reading. And in such cases, like this happened with, I can list down 5-6 instances with asset management companies where, there've been some employees involved and either those employees were penalized or they were barred from the stock exchange. That's kind of been the outcome. It happened with HDFC in 2019. It's also happened with IIFL, Tata, and a lot of it does not always come in public domain. So I think at this point of time, I don't see a reason for somebody to panic and exit from their holdings. So we are definitely telling our clients to, hold on to the existing investments. Second, in terms of, the flows that have to go in, to my mind, like we've seen, flows are either turning positive or the outflows are reducing. And these kind of inquiries could, take months or years to actually complete. So there again, I'm pretty positive on continuing with the funds in the recommendation also from a future flow standpoint. And we're constantly monitoring the situation. So honestly, if there's anything that comes in, we would know about it and take an action accordingly. But as of now, it doesn't look like there's something to panic so much.
Thanks, Shweta. I think so. This is one question which was there across. So, any questions, partners, you can post it in the group, and we'll be happy to take them. And then I'll just run you through the process of how this change is going to take place. You can post it in the Q&A box or the chat, and happy to take them. Yes, Dipankar, we would do that. I'll share the plan of how we plan to communicate about these changes with, of course, the partners as well as the clients as well. Currently, there are no questions. Shweta, there was one question actually which I got it. So there are some schemes in which has not completed 3 years. So there are a few exceptions which we've taken. So
That's right.
If you could just highlight something, is like What was the rationale behind actually including them in our study?
So what happens is, we could have schemes which get eliminated because they've not completed 3 years while they may be meeting the AUM filters. So what we do is we do compute their future return potential and see if there are those outliers. Something like the rest of the funds may be sitting at a 20% potential and these funds are sitting at 30% potential, but they've got eliminated because of the track record concern. So then you could go ahead and include some of these, but out of 177 this may not be more than 7 8, and they go through that entire quantitative screening, and if still they clear the mark, they come into the selection criteria. That's how it works. Last year you had Kotak Multicap which came in. This year, I think there's a Canara Multi which also got added through this. So the exception as of date is only taken on the track record filter, not on the AUM filters.